again, everybody, and welcome to our Market Watch report for the month of May. As always, I'm Dion Zakuski, Branch Manager and Director here of Scotia Wealth here in Central Alberta, and we're going to look at three timely topics for you today. First, what's happening in the markets out there. Second, what's going on with the carbon tax here in Alberta. And last, we'll check out what to do going forward. Should we be doing the old adage, sell in May and go away? So for those that know me, I have three sons, and they're ages 16, 13, and 2.5. And because of that wide range, I joke that we can talk about all sorts of parenting issues. Now, our youngest guy has an insane amount of energy. And I mean, he's one of those kids where if he's going somewhere fast, just like the movie Forrest Gump. But I tell you what, when those legs start pumping and those arms start going fast and he's going as hard as he can, eventually, 9 times out of 10, there's going to be a stumble and a fall. And that's very similar to what we saw the markets do in the first 4 months of this year. Right off the bat, markets were running hard thanks to low interest rates, growth in both the economy and corporate earnings, and the possibility of a trade deal being done between the US and China. Then, May came around the corner, and both the Chinese and the Americans tried to renegotiate parts of that trade deal, and that sent things into a bit of a tizzy, and markets over the last few weeks have kind of bit the dust. So right now investors are wondering, is this going to be the end of 2018 all over again? Well, thankfully, it doesn't appear that way. Talks are resuming. Corporate earnings are still relatively solid, and like my little man, we expect things to dust off and get back to usual. However, this whole trade thing will continue to simmer, and both sides are trying to finish off the best long-term agreement possible. We're going to show you a timeline as how this trade issue has escalated since last summer. So beginning in July of last year, both the US and China decided to slap some tariffs on each other's goods coming into the country. It was about $34 billion each. August came around, nothing was resolved. They each put more tariffs on. September got another notch. The US put $200 billion worth of goods at 10% of a tariff, and you can see by the blue bubbles, US is putting on a lot more tariffs than China. That makes sense because, quite frankly, the US imports up to 5 times the amount of goods coming into their country as the Chinese do going the other way. Markets actually had a pretty good rebound to start this year, and that was because both the sides agreed to start negotiations and to put a pause on anything new as far as tariffs are concerned. Now, as I just mentioned, what we saw happen was both sides came back to the table and before signing off on anything, wanted to renegotiate some deals, and that's where we saw more tariffs come around here in the last few weeks and the markets start to topple once again. Something to keep an eye on for sure. As I mentioned in previous casts, you know what, we expect that deal to get done. They're the two biggest economies and they need each other to trade. But it is affecting things temporarily. Switching gears, the new government here in Alberta is making it job number 1 to kill the provincial carbon tax. So for consumers, this may sound like a really good idea, but keep in mind, the minute the provincial one is dealt with, it's very likely that the default federal carbon tax will come into play. A question we have heard more than a few times is, well, what's the difference? And we have a good chart we want to show you here from our friends at global.ca, and we'll go through the differences between the Alberta one and the federal one. Right off the bat, we see that the carbon price in Alberta right now as it stands is higher than the federal one. So right off the bat, that should give us a lower amount of taxation on things like gasoline and natural gas. Now, keep in mind that once 2020 rolls around, the federal one kicks up to $30 a ton as well, so essentially this tax will become the same. But the largest difference between these two plans is who qualifies for rebates. Under the provincial NDP, only lower income households receive any rebates, whereas under the federal one, everyone can apply. So keep in mind, this does not mean you're getting your money back. It's really you apply for it on your tax return and do get a form of a rebate that way. So it would appear that the federal plan is more beneficial. You could say the lesser of two evils. As far as where the money flows to, in the current provincial one, 40% of that carbon tax is returned back to Albertans. The remainder is sent towards climate change initiatives, some other committees that are defined and some that aren't. When we look at the federal one, it's also going towards climate change initiatives and also small business programs as well. So from here, we'll have to see if the UCP government will follow through. They talk about doing it here by the end of May, as that was a big part of their election platform. As far as the federal one goes, that one may kick in sooner rather than later here in Alberta. And of course, that will be discussed heavily as the future federal election comes around this fall. Finally, when we look at market outlook, market volatility is back, and right now we're seeing that mainly due to trade issues between US and China. So as investors, should we be looking at selling in May and going away, reducing those equity positions? Our strategists at Scotia think that the pace of gains will definitely slow down here. They don't think it's going to totally stop, but volatility will increase. Our personal view here at the Secuse Group is we think that we should be able to get portfolios to grind higher, but it's certainly not going to be a straight line, especially in the next quarter or so. But unless something goes really sideways with the trade issues like we discussed earlier, economies are still in good shape. Therefore, at this point, we're still comfortable with our allocation to growth. In the meantime, even if markets are trading sideways or down like we're seeing the last few weeks, we're happy to collect dividends, or like we like to call it, collecting rent. And portfolios can be advanced just on the receipt of interest and dividends. Our job, of course, is to maintain balance in the portfolios by having different asset classes. So not just in money in the markets, but money in bonds, real estate, infrastructure, and these sort of things to keep our old friend, Mr. Risk, under control. And we'll leave it there for today. Enjoy that sunshine out there, and if you have questions, please call us anytime. It's our job to be here for you, and thanks for watching.